So whether you know it or not, there are these are the two most common different types of accounting methods. One of them is known as the accrual method of accounting, and then the other one is known as the cash method of accounting. And we're going to try to I'm going to try to describe these both a little bit, talk about when they're used and how they're used, and then just kind of talk about the differences between the accrual method versus the cash method of accounting. So, if you're in accounting and you've gone through accounting school, then what you've seen in school is all accrual method accounting. So, but then, for the non-accountants, what is accrual method accounting? So, if you're familiar, with like companies like Ford, Amazon, Apple, those companies, they're big public corporations and they produce financial statements that are made available to the public. These financial statements are prepared on the accrual method of accounting. So, to try to sum it up in my own words, the accrual method of accounting shows the economic reality of the financial situation of the business that you're looking at. And when I say economic reality, you know, what I mean by that is start to think of things like how do you account for something when you prepay an expense? How do you account for something when a customer prepays you for either a product or service that you're going to provide in the future? How do you account for, a piece of equipment that you buy 1 year that lasts you 5 years? Okay, things like that. So this is when accrual accounting, like I said, shows the financial reality of the company, because under accrual accounting, let's say that you buy a piece of equipment for $10,000, right? And then you take a look at that piece of equipment and you say, how long do I expect this piece of equipment to last me? Okay, say 5 years. Okay, so then under the accrual method of accounting, what you're going to do is you're going to list this piece of equipment as an asset on your balance sheet, okay? It's not going to be shown as an expense on your profit and loss, even though you spent $10,000 on this piece of equipment. It's not going to go on your profit and loss statement yet until it's depreciated over that reasonable, useful life of the piece of equipment, right? So in that situation, $10,000 piece of equipment that you expect to last 5 years, you're going to have a depreciation expense of $2,000 per year on your profit and loss statement. That somewhat shows economic reality of the situation, okay? Because it wouldn't make any sense to go, oh, well, I spent the cash, so that's an expense, right? But then here's the piece of equipment sitting in our shop for 5, 8 years, right? So that doesn't really show the economic reality. If you just sat there and you expensed it all, well, then your income would be what they call as understated, okay? And your company would look less profitable than what it actually is, because you didn't spend this $10,000 in 1 year, so to speak. You bought an asset that lasted you 5, so it takes that 10 grand and it spreads it throughout the year. So to try to directly tie that in with the cash method of accounting, this basically just looks like your bank statement, okay? So in that instance, under the cash method of accounting, cash goes out, that's an expense. There aren't really assets and liabilities, so to speak, under the cash method of accounting. There are, but we will. I'm trying to try not to get into too much of that. So to try to tie this back around and compare a better example of the cash method of accounting, let's talk about prepaid expenses. Okay, so you've got expenses, for the year. And the company who you're paying the expense to gives you an option. You can prepay for the whole year up front, or you can pay once a month over the next 12 months, right? So under the cash method of accounting, what would happen is that once you pay this expense and the cash goes out, you book the expense when all of the cash went out. Okay? So again, say it's $1,000 a year this time. And then I can't do $1,000 divided by 12 in my head, so it's like $83 a month. That's probably why. So say you have an expense that's $1,000 a month. Under the cash method of accounting, once you prepay for that expense, you're going to book that $1,000 of expense in the month that the cash went out. That's the cash method of accounting. The accrual method says, no, wait a minute. That doesn't make sense because it's not the economic reality of the situation. Okay, so accrual accounting will look at that $1,000 that you prepaid for an expense and say, oh no, that's expensed over the next 12 months. So that means that once the cash goes out, you're going to list an asset on your balance sheet again called prepaid expenses. It's an asset, just like cash, right? Just like cash. It's an asset to your company. Prepaid expense is an asset, okay? And then you expense that asset at $83 a month until it goes down to zero. You see how that represents economic reality more so than the cash method of accounting, right? So when you think of cash method of accounting, just think of cash. When does the cash come in? When does the cash go out? Cash in, that's your expenses. Cash in, that's your income. Cash out, that's your expenses. That's the cash method. All right. So then think about, a customer prepaying you for services or a product. Under the cash method, customer gives you that cash. Cash comes in, that's income. Okay? But what do you mean that's income? I still owe them something. Under the accrual method of accounting, you book this cash deposit as prepaid revenue. It's a liability to your company. You owe this customer something. So under accrual accounting, when a customer prepays for a service or a product, what they do is they deposit cash, the asset, and then they credit a liability account representing that company owes you something. And then once the company gives up what they owe you, they debit the liability, and then that's when they put it to sales. That's when they put it to their profit and loss statement. Otherwise, it hangs out on the balance sheet, and then you don't see it on the profit and loss statement, right? Because like I said, how the cash method would make a company seem less profitable in certain situations when you consider depreciation and prepaid expenses. You would look less profitable as a business during certain periods of times, right? Under the cash method, but the accrual method tries to take it and show you economic reality. So think about it from the perspective of a cash method accounting record who just got that customer prepayment for services that they're not going to give them until 4 or 5 months from now. Well, under the cash method, I'm booking that as income. I look too profitable now. My business is showing a higher profit than it really is making during this period of time, right? So you can see those are the main, simplest differences between accrual to cash accounting that I can mention, that I can bring up and try to explain so you can kind of wrap your head around the differences. Like I said, accrual accounting tries to show you the economic reality of the business's finances. Cash method of accounting just shows you the ins and outs of cash, and that's pretty much it. Where both, and like I mentioned a little bit earlier in this video, accrual accounting is used to prepare financial statements. Now, when I say that, don't think I mean you as a business owner going into your QuickBooks and recording your income and expenses. That's not, just because you put it into something, a software, that shows you a profit and loss report doesn't mean that you're on accrual accounting. When I say that you're preparing your financial statements, I mean a legit accountant is preparing your financial statements either in the form of a preparation engagement, a compilation, or it could even be as far as an audit, okay? Like I said, producing a financial statement is when you use the accrual method of accounting. Because think about your users of the financial statements. Banks, they don't want to see the cash method of accounting. They want to see the economic reality of who they're giving the loan to. Investors, I mentioned Amazon and Apple and Ford back then. Investors, they don't want to see the cash method of accounting. They want to see the economic reality of the company that they're investing in. Okay? So that's when accrual method of accounting is used, is when you're producing financial statements and you want to look at the economic reality of your business, okay? Now, the cash method is used on 98.5% of the tax returns in this world. Most taxpayers, most businesses even, pay their taxes on a cash basis. Cash method, cash basis. You can use those terms interchangeably. Like I said, 98.5% of taxpayers file their tax return and pay their taxes according to the cash method of accounting, even if you have a business. That's where you start to get into playing the tax games, right? And you remember that taxes are on a cash method basis of accounting. So typically, when you're going into your QuickBooks and you're recording your income and expenses, think about what you're doing. You're pretty much just using the cash method of accounting. And then that's what goes on your tax return is the cash method of accounting. 98.5% of taxpayers use it, and businesses. And then this is where you get into situations that you maybe have heard me talk about before, like, in December, close to year end, prepay some expenses for the prior year in December, so then you can write them off in the current year and you don't have to wait a whole nother year to deduct and take the benefit of that tax deduction on your tax return, because they're on the cash method of accounting. So a prepaid expense, some of them, rent does not count, and then if you get into any prepaid expense that's longer than 12 months, you run into an issue. So let's just, your typical 12-month prepaid expense, right? They're under the cash method. So whenever the cash goes out, that's when it's expensed on your tax return. Same goes for when the money comes in, that's when you pay tax on it. Doesn't matter if you actually gave the customer a service. If that customer prepays you on December 31st for work that you're going to do in April, you're paying tax on that in the year that you received it, not in the year that you provided the service. So then if you provide a service in December and the customer doesn't pay you until January, you don't have to pay the tax until the next year in January when you actually received the cash. So I hope that this video kind of gives you like a good idea as to the different, the two main different methods of accounting. Believe it or not, there's more than two. The other one that I'm not going to talk about at all deals with nonprofits, and in particular, like state and local government entities. It's called the modified accrual basis of accounting, which is stupid. But anyways, so yeah, those are the two main accounting methods that are used and that you will see out there, right? You will see the accrual method of accounting if you're an investor or if you work in, lending and you're either loaning to a company or you're an investor and you're looking at Ford's financial statements. That's accrual accounting. What you're staring at is accrual accounting, economic reality. Your tax return is where you will see the cash method of accounting, because 98.5% of taxpayers and businesses are on the cash method, cash basis, and that is where you will see the two differences. So think about that going forward in your business ventures. Just because your tax return says this is your profit, remember what I said about the difference between accrual and the cash method. The cash method just shows you cash ins and outs, but the accrual method shows you economic reality. This is how you get into situations where a company like Amazon reports an $11 billion profit, accrual accounting profit, but they pay $0 in tax. So no taxable income on the cash method. And from what I explained, you can probably paint a couple scenarios where that happens, where you have an accrual profit, but you have a cash method loss, because it's just cash comes in, cash goes out. Accrual method, economic reality. Hope that helps.